Welcome again, everybody, to this webinar. The title is, as you know, Crisis as a Chance is now a good time to start investing. And at this point, I have some technical details for you. So the webinar will take approximately 50 minutes, and then we will answer your questions. This webinar will be recorded, but no worries, the chat is private, so nobody except the Selma team sees what you write. We have Niklas and Karina active in the chat from the Selma team, and they will constantly answer your questions, and the questions that cannot be answered during the webinar will be answered later by email, so we will answer your question anyways. And there's a little surprise at the end, so stay tuned. And yeah, then let's start with this webinar. So today for you from Selma here is not only myself, but I also have the experts with me. So Daniel and Thomas. Daniel, can I give you the first word? Can you explain who you are?
Thank you very much, Michelle. Thanks for having me. I'm Daniel Thom, the investment manager at Selma. I joined the company 3-4 months ago. I have 10 years of experience, more than 10 years actually now, in the Swiss banking industry. Started as an economist, and now I'm taking care of everything that is investment related at Selma, meaning everything from the setup of the portfolios till the implementation and the client mandates.
Perfect. Thank you. Happy to have you here. And then Thomas, your turn.
Hi everyone. Happy to be here. My name is Thomas. I've been working with Selma for the last 2.5 years. I've more than 25 years of experience in the financial industry, from the stock exchange and everything. I can tell you that during those 25 years, there was plenty of crises, many ups and downs, but I'm a strong advocate of long-term investments, and hopefully I can spread the word today also here.
Perfect. Sounds really good. So then just really short our agenda for today. So we have 4 parts. Part 1 is the current market situation, where you get all the information about that. Then we have the part 2. There's where we explain a bit about Selma, and we have there a really interesting comparison, I would say, between Robo-Advisor, banks, private banker, and Selma. So I'm really happy to hear this. Then we come to your questions, and in the end, as already mentioned, we have the small surprise. So Selma, short and sweet at the beginning, so that you not only know who your speakers are, but also which company is behind it, because today we're like a really mixed group, mostly of you from the Neon newsletter. And I think many of you may not yet associate Selma directly with the Swiss online investment service, which has been on the market for over 5 years. So we're kind of a private banker for your pocket. So we make sure that investing money is not complicated, absolutely not time consuming, and still always tailored to your life situation. So your finances are our passion, and so that we can get to know you a little bit better, we have prepared 2 questions to get started. You can find them in the chat section where there's like polls written, and I will publish them there. So the first question is just shared now. Have you ever invested before? Cool to see all your answers. Perfect. So there are some experts here who has already invested. Then I have like a second question as well. I will share this now. Considering the current market situation, would you start to invest at the moment? Oh, yes, of course. Or too risky? Okay, interesting. So more of you think that it's too risky at the moment. So I'm really happy to start with our part 1, the current market situation. And there, Daniel, you brought us a chart so we can understand a little bit better what exactly happened on the markets in the past. For me, it looks a bit scary or complicated, but I'm sure you have explanation for all of us.
Yeah, sure. I hope I got a good explanation for that. So I think we should start with a look back what has actually happened this year before we then go over to an outlook into the future. Now, what you see in this chart on the left side, you have two things displayed here at once. You have the green area, which is the stock market, in this case, the American S&P 500 index. And you can see that that has been declining a lot this year. We have seen at some points a minus of 23% from the peak we had at the turn of the year. And then you see the blue line overlaying it, and this is the US interest rate for the 10-year government bonds. And that has been shooting up quite a lot this year. So we have had this rather unusual combination of rising interest rates and falling stock markets. As you can see, in the past, it was different. In the COVID crisis that you can see on the left part of the chart, both went down together and both came up together afterwards. That is what is normally the case in financial markets. This time it was different. And that is probably because we had a substantial shift towards higher inflation rates in the developed world in this year. And the reaction to that from the central banks was to lift interest rates in order to get control again over inflation. Now, how did we come to this situation in the first place? After COVID, we had an economic recovery that was supported by a lot of money printing. And then came the war in Europe, in the Ukraine, and related to that, an energy shock, which suddenly made inflation jump. And that boosted an inflation rate that probably was already going up because of the high demand and still some supply problems after the COVID crisis. So this created a perfect inflation storm, if you will. So this marks a turning point now for the markets after more than a decade of easy central bank policies, when always central banks could be relied upon that they would support the financial market in times of crisis. Now suddenly we have a situation where they have to lift interest rates at the same time while the market is going down in order to rein in on inflation. And that is something that markets first have to digest. But still, there is actually, even in this throwback here to the first half of this year, we can still dig out some positive information. Because if you look closely at the chart again, at the green area, you compare the latest level here of the US stock market with the levels in 2019 and 2020, just before COVID broke out. You can see that actually the market is still substantially higher than back then. The US index still grew by about 10% in these 2.5 years since the outbreak of COVID, despite COVID, despite inflation, and despite the outbreak of war in Europe. And I think that already shows a bit the power of long-term investing, that eventually markets rebound, and you just have to be patient enough to see that in your portfolio. Also, then the question, of course, given this inflation background this year, is what to do in general, what can be done about inflation. And actually, even though the market, as we see here, had difficult times this year, we still think that investing is probably the only solution to the inflation problem, because the alternative is to stay in cash, and cash will just guarantee you a loss equivalent to the inflation rate. So you're definitely not going to have any upside. Whereas within investing, as we have seen over long term, the trend should go up and you should have some upside. Also, we should consider that when it comes not to inflation and central bank policies, two things could happen. Interest rates rise further, then at least you would get attractive interest rates from your bonds, or interest rates would go down, then the bonds would regain value, right? That's the typical way bonds behave. When interest rates go down, their nominal value shoots up. So in either case, I think actually the situation doesn't look so bad as it actually appears here on this chart. Last thing to quickly talk about on this throwback, gold. Is it still a good protection against inflation? We think yes, even though in US dollar terms, gold has performed rather weakish lately. If we compare it to other currencies, euro, Swiss franc, it's not so bad. It's actually just given back what it gained, extraordinarily gained during the outbreak of the Ukraine war, and then it gave it back again, but still we are actually at higher levels than in the years before. So also gold, I think, still played an important role here in protecting portfolios against something what we saw also on the stock markets. And that's the throwback. With that, back to you, to Michelle.
Thank you, Daniel. So in the long term, still in the profit zone, I think that sounds pretty promising. But what does that mean specifically for the future? I mean, like the markets and the current situation are still a bit scary.
Yeah, we see here on this next slide on the outlook this stylized chart of a financial market. We are probably now somewhere in this fear or panic area, I guess. The market has been going down quite a while now. Now, first of all, when we look into the future, we have to make one thing clear, put a disclaimer out here that Selma does not make any forecasts about markets or economies. We think there is enough scientific evidence out there to prove that this is not a good strategy to rely on forecasts for markets or economies for investing. This doesn't work in the long term. You're not going to beat the market. So in that sense, first of all, what is important, I think, to consider is that it is important to have a well-diversified portfolio and stick to a long-term strategy, because as we have seen on the previous slide with the throwback, markets tend to recover quite quickly eventually. So this leads us to our very preferred saying that time in the market beats timing the market. I think that has in history always been proven to be correct. Eventually, it is so difficult to time the market that you're not going to have success over the long term. And it's better to just stay in the market and benefit from the good trading days, because actually the best trading days in history have been recorded right after the worst trading days, like in the financial crisis in 2008-9, and also in the COVID crisis 2020, we saw one of the best trading days in history of the stock markets right after the worst trading days, within the next days or weeks happening, which I think shows that it's just so difficult to really time the market. So then it leaves the question, obviously, what can you do further to improve your performance or stability of your portfolio if basically all you should do is having a well-diversified portfolio? Well, but no, there are actually a few things you can still add on that. One thing is, and this is done at Selma, that we add factor investing, namely the value factor, which has been also scientifically proven in the past to have worked well. What does it mean? It means that we have an algorithm that looks at the financial markets and compares the valuations of markets. So is a stock market, like say, for instance, the US market, relatively expensive to the earnings of the companies in that market? And is also this relation actually expensive to the history of itself? If that is the case, then the algorithm would say, put a little bit less weight on that market and shift it to a market which, according to that measure, is actually rather cheap. Currently, if we look at the markets globally, they are all more or less fairly valued, so it's not so exciting on that account currently. If this was not the case, then actually Selma could also do shifts into precious metals. We have seen that in the past, like earlier this year, at the turn of the year, many stock markets were very overvalued according to our measure. And at that point, then Selma decided to remove a bit of weight from all these markets and put it into precious metals, and maybe also to a certain extent to real estate, private equity, and bonds. So to summarize, the protection of the portfolio comes from three factors ideally: having a well-diversified portfolio, sticking to your investment plan and not panicking, and adding the valuation adjustment and precious metals. And I think now one part that is very important here is sticking to investment plan and not panicking. This is something that Thomas has a very good slide where he can explain in even more detail what actually is important to watch out for on this regard.
So then I would say you can start, Thomas. Your slide.
Thank you. Thank you, Daniel. Thank you, Michelle. As Daniel already said, emotions are a really bad advisor when it comes to investing. So when it comes to investing, and has proven over so many years with talking to so many clients in the past, when it comes to investing, of course, everybody fears that, okay, I might lose money. And losing money seems to hurt much more than the joy of winning money. But what we also know from the longer money can remain invested is that in the end, markets turn around again, they go higher, and that's where you should also then see gains again. And as Daniel also rightly said, it's so difficult to wait for the optimal timing of the market and to wait for the optimal time. When should I start or when should I invest more? It's more or less impossible. Nobody can do that in a significant way. So this is why we say, do not even try to do that, but stick to your investment, stick to your investment plan, and stay invested for long. With long, we mean at least 3 to 10 years. And one more thing I would like to say here, also one example is that maybe describes very well how differently we react to turbulence in markets. Just imagine you go to the supermarket and then you see a sign that tells you, okay, today everything is cheaper by 25%. The first reaction probably is, well, that's great. Okay, let's go in and buy something. I want to buy something because now I get it much cheaper than just a couple of days ago. Now imagine you read the same in the newspaper and you read, oh my God, the stock exchange has come down by 25%. Probably every one of us will panic and think, what is going on here? Do I have to be afraid? Do I have to sell? So it just explains to you how differently we react in different markets. The stock market brings fear, brings maybe emotions that we can't control. And that's why it makes it more difficult to maybe even start investing. And that's what we try to picture here also in this chart. So here in the black chart, you see basically a theoretic development of markets. So on the left, you see that they start and then they go up a little bit, and then there might come a crisis and markets turn lower again. Initially, we think, okay, nothing serious will go on, so I will sit this out. But then fear starts to creep in, and fear might even turn into panic when markets go low even more. And then in the end, one draws the final line and says, okay, now I want to get out of it. I don't want to see this anymore. I want to save what I have, and sells everything that was invested, which might actually feel for a short time actually pretty okay, because the markets might even go lower, and then you feel happy at the beginning, and like the hero of the day. Okay, I sold I sold even higher, even before markets go even lower. But then eventually, and this also happens and can happen actually pretty fast, as Daniel pointed out, markets start to turn again and they go higher, and they gradually go higher. They might even go higher pretty fast. And then eventually you might even miss the right moment where you should invest your money again. And in the end, if everything goes even worse, you might even end up in buying things back at a higher price than you initially sold. This is not something that we came up with at Selma. This is something that you find in every textbook. So they call it emotional finance. This has been studied by academics, and this is like, unfortunately, something like a usual behavior of many people out there who invest money. And this is why we say it is so important to try to keep emotions out of investing and of your investment decisions.
So yes, emotions aren't the best advisors, but I would say neither is our impatience. Can you go more into detail, Thomas? Why is it important to go for the long-term investing?
Exactly. I think now you raised a very important topic. So what we say at Selma is, in case you invest money, and yes, you should invest money, but only invest money that you think that really can remain invested for the long term. With long term, we mean at least for the next 3 to 10 years, ideally more than 10 years. Of course, you can always withdraw from your investments at Selma. You can always get your money back. So this is not the reason why we tell you about long term. You can do that at any day. But the main advantage of investing long term is this famous concept, this magic concept of compound interest. What does compound interest mean? Well, it means that you get an interest rate every year, you get a return every year on investments. One year it might be higher, another year it might be lower, but on average, you will get return on your investments. It means that your investments grow over time, which again triggers more return in the future, and so forth and so forth. So it's this famous snowball effect that money starts to work on your behalf. You can actually, we try to depict it here on the left side in the chart. This is like a simple chart where you can see an assumption of investing 500 Swiss francs every month and for the next 30 years, so 12 times a year, 500 Swiss francs for the next 30 years. What would happen if you just do this with your bank account, with no interest rate at all and no return at all? So after 30 years, you would end up with about 180,000 Swiss francs as cash on your bank account. Remember, there is inflation. This cash will buy you much less in 30 years than it does now. What would happen if you do that in an investment account that on average gives a return of 7% a year? You might now say this sounds a little bit high in this kind of environment, but actually this is also historically relevant and the investment return that can be achieved. So again, if you would invest every month 500 Swiss francs, 12 months a year for the next 30 years, you would end up with altogether close to 560,000 Swiss francs. So much, much, much more. And here it tells you also what you see in the graph, that the difference between the bank account and the investment account becomes higher the longer you do that. The longer money can remain invested. So that also means that the stronger this compound interest rate effect gets. This is what we call investing. So it's not speculation. This is what we call investing.
Sorry, Thomas, didn't want to interrupt you. Just one thing to add here. I think it's important because we get the question quite often that obviously the markets will not go up in that smooth line over time. It will be a bumpy ride like we saw this year. You will have bad years where you have a negative return. But what history showed us that when you have a bad year with, say, minus 10% return, there will be years with a 20 to 30% return afterwards. So the 7% is an average approximation over time.
That's a very important point. Thank you, Daniel. Yes. So, of course, different years might bring different returns. So this is an average rate. There might be good years. There might also be some bad years. But history has shown us that in the end, you will get a positive return.
Perfect. So thank you both. But Thomas, let's go to the probably most important question from tonight's webinar. Is now a good time to invest?
Is now a good time to invest? Well, actually, we think it's always a good time to invest, and now is also a good time to invest. Please remember also that markets have already corrected quite a lot. So as Daniel said, they have already come down more than 20% this year. So definitely you get things now much cheaper than half a year ago. It of course also doesn't mean that they might not even go lower. So this is why we say always, yes, you should invest, but keep certain rules in mind. Some very important points that you should always keep in mind when investing money. First of all, as I said before, only invest money that you really think can remain invested long term. Again, ideally more than 10 years. Then only invest in a way that fits to your personal life, to your financial situation, also to your willingness towards risk, so that you can still sleep well during the night. To find out how you should invest, this is definitely where Selma will help you. We will get an individual investment plan, as we might even see later. Do not invest money that you might need in the future. In the near future, maybe you have already planned for some buying a house or refurbishing a house, maybe buying a car or a nice long vacation around in a warm country in the winter. So if you plan, if you already know that you have these kind of expenses, do not invest that money. And also always keep what we call a cash buffer. So this iron reserve of cash that should always be kept on your own bank account and not not on your investment account, just as kind of an emergency. And I think this is also very important, especially in this time of when markets are a little bit turbulent and go up and down quite fast. Do not invest all your money at once. It makes much more sense to start with a sum, maybe with a smaller sum, just to test the ice, dip in the toes into the water, and then gradually build your investments over time. For example, most of our clients at Selma, they're actually using Selma for monthly investments. So they add this regularly, they add a certain amount of money. Sometimes they buy it, it gets invested on a higher level. Sometimes it gets invested at a lower level. But in the end, you end up with a nice and stable average price, and you can build and continue to build your investments over time.
Perfect. Thank you very much. Now we can already start with part 2, the Selma part. And as I already mentioned, Selma started as a startup more than 5 years ago, and we have big investors involved. Anyone who does their weekly shopping at Migros has also indirectly supported us because Sparrow Ventures belongs to the Migros group. And the Takes Group, as another major investor, may not be known by name, but if you read 20 Minutes or create a doodle when you organize your annual Christmas dinner, then you're basically using the Takes Group. So these are well-known and very valuable companies for us as investors, but we are also like a steadily growing team. So we are a mix of financial experts, software developers, designers, and also creative minds from 8 nations. And we're so happy to have more than 10,000 happy clients. This is also shown to us by the amazing positive feedback from customers. So we have like over 290 reviews. That's like really, really great for us, a good feedback. So one question before I go to the next slide, one question out of interest. I will also do this in the polls. It's about if you have already signed up at Selma. I will share the question now. So maybe you can answer this before we start with the next slides. Are you already signed up at Selma? Oh, that seems to be pretty clear. So most of you are not yet Selma clients. That's really good, because when I then come to the next slide, Thomas will explain you briefly what it looks like if you want to start with Selma, because you're the specialist, right?
It's very easy. Exactly, it's very easy. You can do it, of course, online. So you go to our web pages at www.selma.com, and then Selma will guide you step by step how to set up your profile and how to open then an investment account, or maybe even the Pillar 3A account if you want to. Selma will just ask you during this process a couple of questions, both on your financial situation and then also what's your willingness to take risk. And out of all these different data points, Selma then comes up with a personalized and individual investment plan for you. You can, of course, always follow and see that plan and your profile either on the mobile app that you can download for your iPhone or for your Android phone, or then, of course, also on our web pages when you log into your user account. So as I said, what Selma will do with your profile, as we call it, it will tailor-make a financial plan for you. So it's based on your profile, on your financial situation, your attitude towards risk, and then it will be tailor-made to your financial situation. What Selma will then do, Selma will invest your money with the help of ETFs. Maybe you know that concept already, maybe you know ETFs. ETFs is a very good and very cost-effective way to invest your money. It means that with one instrument or a couple of instruments, you can very broadly diversify your investments. What does diversification mean? Maybe you heard it from your grandmother. It means you should not put all your eggs into one basket. So this old rule of spreading the risk, not betting on one horse, but spreading your risk, diversify your investments. This is done at Selma with the very good help of ETFs. And as I said, if you want to, you can also open a Pillar 3A account. You can also transfer an existing Pillar 3A account to Selma. The advantage of that could be that Selma is actually the first and only digital provider in Switzerland that allows you to combine both accounts, the regular investment account and the Pillar 3A account, and then looks how much money you have in total invested with Selma, and that might even give you the opportunity to have to pay lower fees at Selma. So the more you invest, the less you will pay with Selma.
So now you know how you can easily become a Selma customer, but I don't know how you feel about that, but with the many offers and different providers these days, it's always difficult to find out the differences between the providers. So Daniel, you brought us an exciting overview since you have many years of experience as a private banker at a major bank. You know that only a few customers can really benefit from all the advantages of the whole banking service. So would you help us comparing the different options?
Sure, I'm happy to do that. Yeah, I don't want to spend too much time on this slide. I mean, there's a lot of things you could spend a lot of time on, but just to summarize it, I think there are four ways you could invest your money in. You could go to a bank, traditional, very old school way of investing, or you can go to one of the robo-advisors online, or if you're wealthy enough, maybe you have access to a private banker. And then as a fourth alternative, there is Selma. And I think what makes Selma interesting is that it's kind of a combination from the robo-advisor function and the private banker function. And what does it mean? Robo-advisor is, thanks to the newest technology in the last few years, kind of a replacement for the traditional bank offering, right? So basically the robo-advisor can offer standardized portfolios at a very low cost, also thanks to the ETFs that Thomas mentioned. And the private banker, what he does or she does on top of that is giving management services, like making sure that your investor profile is continuously updated as your life changes, that you inform your private banker, suddenly I sold my apartment and I have a lot of cash to invest additionally. What should I do with it and how should I invest it? Your private banker would recommend you something. And also, of course, things like making adjustments to the markets and measuring things like under and overvaluation and adding these strategies to your portfolio. These would be all these more exclusive services that you would know from a private banker. And I think that makes Selma stand out, that we can combine the low-cost standardized portfolio approach from a robo-advisor, but actually then we make it more sophisticated, so we don't have standardized portfolios. At a robo-advisor, you would get one of maybe 5 portfolios, depending on your willingness or ability to take risk. At Selma, every portfolio is tailor-made for you, and there's a much finer granularity in the differences of the portfolios. And also, very importantly, then after you have invested your money at Selma, it's not like the story ends there and there is nothing happening anymore, but that's actually just where this work starts for Selma, that then your profile, your portfolio is monitored constantly, regularly, and updated as your life changes. That can be simple things like you get older, and as older you get, the less risky, obviously, you should invest, because if you are, for instance, shortly before your retirement age, you don't want to suffer a 30% setback from equity markets. So you may want to put some of your money into more stable investments. And also we can do these adjustments, like I explained before, with measuring over and under valuations and shifting automatically parts of your portfolio into precious metals, for instance, to protect your portfolio in more difficult times. So I think this combination of services makes Selma quite unique in this market here.
Perfect. So this comparison makes it pretty clear how the work and the included services are differently. So what exactly happens once an account is opened at Selma? What do I have to do, Thomas?
Yes, as outlined, you can open the account online on our web pages, and then an investment account will be opened in your personal name. As soon as the account is open, you will receive an automated message from Selma, where you then can see also the IBAN, so the personal account number of your investment account. So the only thing you have to do at the beginning, to make your first deposit. So to send some money to the Selma investment account, and as soon as you do that, Selma will start with investing your money. Then, of course, the way Selma invests the money is based, as we outlined already, on the individual plan that Selma puts together for you, and it is based on your profile. What Selma would also do, in case you would like to start to invest or to start with a higher amount of money, let's say more than 5,000 to 10,000 Swiss francs. We have customers who start with 50,000, 100,000 Swiss francs, or maybe even more. So you're, of course, totally free on how much money you would like to deposit. But in case you would like to start with more money, then Selma would automatically not invest all the money for you at once, but again, split it over a certain period of time. And the reason for that is, as outlined before, that markets can fluctuate short term. They can go up, they can also go down. And spreading out the investments over a certain period of time just allows you to build those investments at different prices. You buy a little bit higher, sometimes maybe a little bit lower, and end up with a more stable average price. What is also very important for us, and should also be very important for you, is transparency, so that you always know how your money is invested. You can see it at your Selma mobile app, or then on your web app. You can see at any time in what kind of different funds my money is invested. Is there still cash on the investment account that will be invested later on? So transparency is very, very important, so that you know what is happening with your money. We even have this famous Selma log, where you can also see if Selma is already planning some future investments for you. So again, transparency is very important.
So we saw in the comparison slide before that adjustments to the financial situation are something that somehow only Selma can offer in the online world, I would say. Why are regular adjustments so important, and how can we help?
Yes, of course. I mean, as Daniel already pointed out, your life might change. I mean, you might get a new job with maybe a higher salary that allows you to save more, put more money aside on a monthly basis, or then you might decide to buy a house or to buy an apartment, or then you might maybe also in times like this be a little bit afraid, what happens with my job? Maybe I cannot earn for a certain period of time that much money as I was used to. So all these things you can put into your profile at Selma, and then Selma, of course, will immediately check whether your investments should then also be adjusted or not. So you're not left out there alone. Selma is here to help you with putting together your investments and to react when something happens in your life. This all happens automatically whenever you do update your profile on your web pages. What we also have is like this human factor. So in case you prefer that you would like to talk to somebody, not only discuss with the algorithm or with Selma, with your very nice financial advisor, But if you really like to talk to somebody from our financial team, that's also possible. So you can always drop us a chat, you can write us an email, you can ask for a free financial checkup, and then our financial team, one of our very able financial experts, will have a look at your individual situation and come up with a solution to you and get in contact with you.
So not only our financial life is constantly changing, I mean, the markets also have their own script. So what exactly is Selma doing here, Daniel?
Yeah, exactly. I think we've touched on this issue already a few times before. So we do these adjustments based on the valuations of markets, and here maybe spending 2 more minutes on the details, how this is done and what does it mean for a portfolio at Selma. How is it done? There is this thing called the Shiller-Cape ratio, named after Professor Schiller, who invented it. CAPE being the abbreviation for a cyclically adjusted price-earnings ratio. So as you may already derive from this abbreviation, what it means is, as I explained before, you compare the price of the stock market with the earnings of the companies inside that market, and then you cyclically adjust it. In other words, you compare it to how it behaved in the past. And this means then that, as I explained before, Selma could say all the financial markets, all the stock markets are very expensive. That was the case end of 2021. And could then say we should reduce the weight on all of these stock markets and reallocate your money that you otherwise would have invested in those markets into something that protects you from the risk that these markets correct back towards their long-term fair valuation. This would then mean, as I said before, shifting these investments more into precious metals mainly. And actually, Selma did that end of 2021, early 2022. We had a substantially higher share of investments in precious metals, and that helped quite a lot in the initial stage of this market correction in the first half of this year. At some point in many portfolios, there was a precious metal share of up to 20%, which is quite a lot higher than the usual around 5% share that would be normal at Selma. And I think it helped a lot during the market correction. This is something that is also, I think, a unique thing. Selma here clearly being having a standalone feature with a adjustment to precious metals, which is not offered by the traditional robo-advisors or the alternative robo-advisors you could see in the Swiss market.
Perfect. So I will then do a short conclusion to finalize or to sum up everything. So Selma is your digital financial assistant that takes over the task of a private banker and looks at your personal financial situation. We create an individual plan and we're taking care of everything for you. And no worries if you don't get the word with Shiller-Cape ratio or something like that. We also have a really good blog for this with good financial lingo explanations. And yes, you have time for the really important things in your life, and we do our work on our side.